Okay, it's Tuesday the 18th of October. We're just about at 9:15 and we are on the Australian dollar, US dollar. So for today's trading, basically I've been watching the FTSE 100, which is also at a key level. However, that market has just rallied and it's starting to break out of the zone. So Australian dollar, US dollar, basically with the Sunday analysis video on the YouTube channel, we had this market as bullish, expectations of it coming up into these levels right here. Now that the market is up here, we have strong resistance levels. It's lining up with the sloping resistance that we identified in that Sunday video also. So I've been watching in here for reactions also. Really for me, this one right here was the signal. 840, got in below the low of that candle, and now I'm just watching the market. So things to watch out for in this trade. Just want to be a little bit careful at these levels right here. The market pushed up. There was technically an entry candle right here. However, for me, it was too close to these levels for me to get into the trade. However, up here, slightly higher entry gives the trade a little bit of wiggle room, and I was willing to step into the market. Want to manage the trade here, see how it reacts if/when it comes down here, and then after that, really down at these levels here would be the target for the trade. So what I'm going to do is I'm just going to let the trade run. I will turn the video back on if it starts to come down. If I'm making any decisions, actively managing the trade, I will talk you through exactly what I'm looking at and what is going on in the market. But that's basically what I'm doing. Short after this candle right here. When the trade completes, I will take you over the support and resistance level on the higher time frame so you can see why I was looking at it. Management point right here, targets down towards this level here. Okay, so the market is just starting to come down into the management point. We can see the last candle here at 920, and it turned into a doji candle. It spiked down and then rejected back up, and then this candle here is now coming down. So now that the market's here, I just want to see how it reacts. What I don't want to see is basically a continuation move. So creating highs, creating a new high, coming back to test the previous highs, and then bouncing off. That's your typical trending move. That's typically how the market will move if it is trending. If I start to see that, I will just exit the trade. You need to give it a little bit of wiggle room. You can't be completely robotic about it. There is a lot of noise in markets, especially when trading lower time frames. So my target remains down toward these levels down here. We are now at the management point, so I am just watching to see how the market reacts. Okay, so what we have seen is the market has reacted to the management point, which was to be expected. I mean, if you've got a management point, it's because it is a likely spot for people to get into the market. However, when looking at the reaction, what I'm looking at, well, the first thing is the reaction was not overly strong. It hasn't really made any significant ground to the bullish side. The candle itself isn't overly strong in comparison to the previous candles that we have seen. So for me, that means I am willing to remain in the trades for now, still looking for more bearish action coming into this market. Okay, so the market pushed up a little bit and it has rejected once again, and we're just hovering at these levels. I'm trying to think of a good way to explain when trades do this sort of thing. Basically, the way you want to think about it is when you enter a trade, what you're doing when you're entering a trade is, well, hopefully if you're doing it correctly, you're picking key areas in the market. So either, you're taking a breakout trade at a key level when you think the price level has been broken, or you're entering into a reversal trade at a key level where you think the sentiment is going to change. Now, at these levels and where you're entering the trade, what you've got to think of is there are types of, well, we can call it a pivot point. I'm not talking about the pivot points you plot daily, official pivot points. I'm talking about in each individual trade, you have a type of pivot point. It tends to be very near to your entry. And what this point is, so if we mark this in, I'm just going to draw a little line right here, round about here we can say for this one. It's an area in the market where both buyers and sellers are interested. So we've had a bullish run up, which means lots of bulls are still looking at this market, still attempting to push it higher. They are looking at this as a bullish trend. When they've seen this, they're looking at that as the pullback and going for continuation. Where I'm stepping in, I'm looking at it as a reversal point at a key resistance area. So what is happening is the price level in between these two levels is where bulls and bears are battling. So the bulls are trying to hold the market in an attempt to force it higher. The bears are looking to step into the market to push it lower. You're going to see this almost every trade you get into. It's almost always near the beginning of the trade. If you're getting in at key levels, it's essentially a battle, between bulls and between bears. That's what the market is overall. It's a constant sort of tug of war between bulls and bears. But where you're stepping into trades, especially if they're at very important levels, very often you're going to see that magnified. It's an important level for both sets of traders, and so very often you'll see things like this. I said I was expecting it to come down into the management point and then we'd see a little bounce. It's exactly what we've seen. As the bounces came higher, bears have now seen the reaction here, which is pushed down. They've used this pullback into these levels, right here, the congestion, as a way to step into the market. So this would be the second wave of bears now stepping in. This would be the second waves of bulls stepping in. We've had one wave here and the second wave right here. It's why a lot of people can get nervous when they first get into trades. They get into a trade and then in their minds they'll think, how come every time I get into a trade the market starts to chop or it starts to move against me? I'm doing everything I'm supposed to do, I'm picking the good levels, and I'm entering into trades that align with my trading plan or all of my trading confluences. That's the reason for it. If you're stepping in at very important levels, there's always going to be a to and fro. The levels very rarely just give up completely off the bat. You're always going to see the bulls stepping in, and you're always going to see the bears stepping in also. The important thing is you just have your trading plan ready. You have your management points, your targets, and you know what you're looking for when in the trade. So you know the reasons that you would use to get out of the trade. And it's only if you see those things that you exit the trade. Everything else is just, you don't even need to pay attention to it. The market is going to move all the time. It's never just going to sit still. You're not interested in that. All you're interested in are the things that you need to see. So you need to see your management point reached. You need to see something to get out of the trade. You need to see something to stay in the trade. And then you have your target. That's all I'm doing. That's all I do when I get into trades. What I'm looking at now is we've came up, created a high, created a higher high, and created a lower high. Potentially we have a very small head and shoulders pattern at key resistance level, which is lining in with sloping resistance. It's just adding a tiny little bit of confluence to the trade that I'm currently in. Okay, so we're just going to let this continue to run. Nothing's really happened as yet. I'm still just watching the market, waiting for the initial reactions to settle down, and then we can see if we get, or what direction we get from the trade. Okay, so the market has popped up just a little bit, and what I'm doing is bringing my stop down because the reaction has came off of the management point. So it is going to sit right here. This is my stop, and basically brought down above the high of the entry candle. If the market pops up there now, I will exit this trade for a loss. Apart from that, I'm still looking for the market to come back down. So now that I've had the reaction off of the management point, what I've done is tightened the stop, and that is the only alteration to the trade that I make. Okay, so the market has came down. It's fallen down very, very slowly, but it has got there. Basically, where it spiked up, we lowered the stop. The trade then turned around, fell back down, paused once again. You can see the level where it kept pausing, and now it has fallen through. It basically came down into which one? This one. These levels right here. And because the market is moving so slowly, we've shown a little bit of rejection here. Then we've had a doji candle. For me, that is the signal to get out of the trade. So 10.5, 11 points. You just step out 2 points, 3 points early, because that's what the market is telling me to do. As I always go over, there's no point in staying in a trade for 1-2 points steadfastly, thinking that, oh, my target's 2 points away, I'll just wait, letting the market reverse and move against you. Okay, so on the daily time frame, let's have a look at this trade quickly. As mentioned in the Sunday analysis video that I did, basically Friday was here. We closed just above this sloping resistance line. My analysis was our next likely move was up into the upper sloping resistance line. That's where the key level was today for me. Once it triggered my alarm, I was watching for a reason to get into the trade, being a little bit careful of the previous highs, which meant I had to wait until we got a little bit further up, giving me more wiggle room in the trade. And then, sorry guys, the recording software stopped there. So basically it got up into the key levels. I got my signal here with enough room down to the management point. Got to the management point and bounced off slightly. As we bounced off with bullish, relatively strong bullish sentiment compared to the rest of the morning, stop came down, tightened just above the high of the entry candle, and then the market just drifted very, very slowly all the way down to just above the target. Exited just above the target after I seen the rejection and the doji candle a couple of points away. So another very nice trade. As always, guys, hopefully that was helpful. I'm James Orr, and thank you.